Hi, this is Brock Jolly with Veritas Financial. Excited today to talk about a topic that is probably not the world's most exciting topic, but certainly one that's critically important. One of the things that we talk to our clients and prospective clients about all the time is the balance of risk management and wealth management. And let's be honest, in financial planning, one of the things that everybody wants to talk about is the wealth management side. What's the next new hot stock? How do I get the best return on my money, et cetera? But for a lot of clients, of equal importance, or maybe even more importance, is managing risk and understanding how that piece of financial planning comes into play. And as we dive into risk management, I mean, that's everything from legal agreements to insurance to simply making sure that you're doing things the right way and not taking on too much risk in an insurance or in a investment portfolio, et cetera. But today I want to talk about one of the strategies that we frequently utilize with some of our clients, certainly not all of our clients, but it has to do with life insurance strategies. And what I mean specifically is the utilization of permanent life insurance as part of the financial planning strategy. And the way I often describe it is this. For most of our clients, when they come to us, they've got a number of issues facing them. One of those might be that they own a business. They've got children. They've got a mortgage. For some reason, there's a need that can be addressed using life insurance. In other words, if they were to die tomorrow, someone, something, some person, some organization, etc., would be harmed by the fact that they are not here. And life insurance is probably one of the greatest ways of addressing that, often for pennies on the dollar. And so the idea here is, for a lot of financial advisors, their way of addressing it is to say, okay, go get a big term life insurance policy. It's going to cover you for, let's say, the next 10, 15, or 20 years. And at the end of that time period, presumably you won't need life insurance or death benefit protection. And I would tell you, look, in every financial plan, certainly that's the hope. But the way we approach it is a little bit different. And part of that reason is, as I look at every other type of insurance on the planet. And I won't give you an exhaustive list, but just think of the basics: auto insurance, homeowners insurance, health insurance, disability income insurance, long-term care insurance, et cetera. Those are all kinds of insurance that a person could own and never, ever utilize. In other words, think about your auto insurance. When was the last time that you had a major automobile accident that was your fault? For some of you, that answer may be never. For some of you, that answer may be 15 years ago. For some of you, let's face it, the answer might have been 6 weeks ago, but it's rare. And it's very easy to say you could go the rest of your life without having a major automobile accident. I certainly hope that that's the case. You can do that across all those other lines of insurance that I just described. Life insurance is different. It is the only insurable risk that we have as human beings where there is a 100% certainty of that thing happening. And I apologize if that's bad news. That's just the reality, right? Nobody gets out of here alive, or as I say sometimes, Harvard Medical School just did an exhaustive research study that found one common result, and that is everybody dies. And so with term life insurance, the only reason that any insurance company is willing to give you or me or anyone life insurance, and specifically term life insurance, let's say a 20-year term policy, the reason that an insurance company is willing to give you or me coverage is because they don't think you're going to die in the next 20 years. So give me $1 million of 20-year term insurance. Maybe it costs $1,000 a year. And good news, we fast forward 20 years. You didn't die. You're still here. But what do you have to show for it? And back in the olden days, the answer was a stack of voided checks. Now it's just a digital copy of that check. But the point is, you paid money in, you had peace of mind, and there's some value to peace of mind. But at the end of the day, you have nothing to show for it. versus with permanent coverage, you have every single dime that you ever put into it plus interest. And again, lots of variables here with the type of coverage, how it's owned, what the premiums are. I'm speaking very generically when I say this. But in general, you have everything that you put into it plus interest. So now hopefully you got to that point 10, 15, 20 years down the line where you and I and your CPA and your attorneys and all of the advisors can generally agree you don't need death benefit, or at least it's far less important than it was when you first purchased it. You know, maybe the kids are out of the house, the mortgage is paid way down, maybe it's paid off, maybe you sold your business for lots of money. We can all agree that you don't need death benefit. But now, presumably, just standard life cycle, now you're going into the phase of your life where you're coming down the mountain, right? You've accumulated wealth, and now you start to come down the mountain. And I often draw this for clients, and so I'll do that here real quickly. If we can pull this up. So the idea here is, and I'll draw it like this. This is a kid who grew up in the Midwest version of what a mountain looks like. And so if you think about it, right now, for many of our clients, they're climbing the mountain. They're accumulating wealth. And my question is always, okay, in mountain climbing, what's the goal? And I've asked that thousands of times over the last 25 or so years. And the answer is almost invariably to get to the top of the mountain. And I'll say, look, I've had the benefit of climbing a few mountains in my lifetime, and I've talked with a lot of folks who have climbed mountains. And I'll tell you, their answer is often a little bit different because they say, yeah, the goal is to get to the top, but just as importantly, or maybe more importantly, it's to get back down safely. And I think that's a really good analogy for retirement planning, because the goal in retirement planning is not simply to get to the top of the mountain, it's to get back down safely. It's to make your money last at least as long as you do. So here's my question. How long are you going to live? And if you can answer that definitively for me, all of a sudden financial planning becomes pretty easy, right? And we know, if you look just historically at the way that things have gone, we know that historically there's a downturn approximately every 5 years. So depending on your age and where you are, I mean, you might remember, use a year. I usually use 2008. So in 2008, the S&P 500 was down something like 37%. In fact, it was down exactly 37%. And so I'll say to clients, okay, in 2008, did you lose some money? The answer is usually yes. But the reality is for most of them, look, I'll use my example. In 2008 was a great year for me because in 2008, guess what I was doing? I was putting money into the market, right? And the market did this. It went way down, and then eventually it came back. Okay, I got to buy in when the market was down. But think about somebody who maybe retired in 2000 or 2006 or 2007. They aren't putting money into the market. They're pulling money out of the market as it's going down, and they're forever locking in those losses. Warren Buffett always says, buy low, sell high, right? Well, they're doing the exact opposite. As the market's coming down, they need groceries. They need to pay the mortgage. They want to take a vacation. It doesn't matter whether the market is up, down, and sideways. So what we do is oftentimes we'll say, okay, look, if you got to this point where you had a need in your working years for life insurance, and now you got to the top of the mountain, you don't want a situation where now you just let the thing lapse or you let your term life insurance expire. If you own permanent life insurance, and ideally if it's fully paid for, right? Because you did a limited pay whole life or something like that, that's paid in 10 or 15 or 20 or at age 65, whatever that may be. And now you take this first step down the mountain, okay? But here's the issue is, look, the stock market doesn't know that you retired. And so still about every 5 years, on average, there's going to be a downturn in the economy. Now, I will tell you this. In retirement planning, the day that you retire, all the rules change. Just as I said that when you're accumulating wealth, a year like 2008, when the market was down 37%, that's a great year for you and me. And if you're younger, maybe you use 2015 or 2022 or one of the other years when the market was down, not to that magnitude, but the market was still down. When you're accumulating wealth, it doesn't really matter because we do it based on averages. But once you start distributing wealth, the order or the sequence of those returns matters tremendously because now we're pulling money out. In retirement planning, think about your financial risks, right? And you might say, well, I have market risk, I have volatility risk, I have withdrawal rate risk. You might say, well, I have interest rate risk, I have purchasing rate risk, sort of the same thing. You might think about medical expenses. Sometimes I hear people say, well, I might die. And I would submit to you, dying is not a financial risk. In fact, it's the opposite. What I mean by that is longevity is the biggest financial risk. Not dying is a huge risk. You know, where this hits home for me is I use my mom as an example. My mother retired in December of 2010 and she died in July of 2011. Now, if you knew that that was going to be the situation, right? If my mom knew that that was what was going to happen, she had a crystal ball and she knew that, she probably would have lived her life very differently, probably would have retired sooner. But that's what happened. And so my point is this. We don't know that, and we can't live assuming that something like that's going to happen. And for our clients, when they plan to retire, maybe at 65 or 70, we've got to make an assumption that they're going to live, obviously based on life expectancy and current health and these sorts of things. But my assumption as a general rule is that you're going to live to be 95 or 100 years old. We've at least got a plan for that, right? If you only live to 85, okay, well, the financial plan worked. But that down the mountain is a really, really long way. And so now what I can do is I can take that permanent life insurance policy. And again, we like to use whole life, but not exclusively. One of the reasons we like it is that it's not tied to the market. And so now what you can do is in those years when the market's down, rather than pulling out of your other market-linked investments, right? Your stocks, your bonds, your mutual funds, and that would include a brokerage account, a 401k, an IRA, any of those type of things that are tied to the market. Instead of pulling out of those type of assets, you pull out of some asset that's not tied to the market. And permanent life insurance is a perfect example of something that's not tied to the market, has guaranteed growth. And how about this for an even sweeter situation? When you pull money out of the cash value of your life insurance policy, in most instances, it comes out tax-free, which is huge. So now I can do all sorts of other things. Maybe I pull out of my taxable investments until I hit the top of a certain tax bracket, and then I pull any remaining need for retirement income out of my tax-free bucket, the cash value of my life insurance. Maybe I pull out of my IRA up to the amount that I need to take my required minimum distributions. But then I take the remainder out of the cash value of my life insurance. Again, the idea here is I've made a determination. I don't need the death benefit. I might really want it, but I don't need it. And so now what I'm able to do is I'm able to stretch those dollars a lot further, and I'm able to answer at some level that longevity risk question. And so the other side of this too is that for a lot of people, something I see all the time, they might be in an 80% stock portfolio, right? 80% stock, 20% bond, or even 90% stock, 10% bond. But as they get closer and closer to that top of the mountain, as they get closer to retirement, they start pumping the brakes. They start saying, okay, I'm going to move this money into a more moderate or more conservative portfolio. And depending on where interest rates are, that may derail the entire plan. Because from the early 90s, maybe even late 80s, through the mid 2020s, that meant that you were probably locking in an interest rate of around 2, 3, maybe 4%. And so if longevity is a concern, locking in an interest rate like that is a real issue. And so we want to avoid that if we can. And By owning permanent life insurance, where the death benefit is less important than it was maybe when you had young kids or a big mortgage or a fair amount of business income, that type of thing. Now you can say, hey, I'm going to reposition this amount of money and I'm going to be able to make decisions from a position of strength. And it's permission to keep that money more aggressively invested. Again, market's doing well, pull out of those market linked investments. Market's not doing well, you've got this asset that's not tied to the market from which distributions come out tax free. And it really, really serves as a buffer or an insulator against that variability, the volatility of market performance. So, again, in all of this, there's no one size fits all. There are pros and cons to every single financial instrument and financial strategy. But I think the key is what we really try to do with clients here at Veritas is help them understand the bigger picture. Understand that it's not about the products, it's about the strategy. Then it's about the tactics, and then ultimately it's getting the right tools, right? So if we're talking about life insurance, it's here's the strategy, here's the economics of how this works and what you need to understand and how it can potentially even create more wealth for you as a result of ownership than if you didn't own it. And then it's about the tactics, right? How do we do it? When do we pull from bucket A versus bucket B? And then lastly, what are the products? Who's the carrier? A highly rated company where you get the best possible rating. All of these type of things go into the conversation for us to be able to find a strategy that's going to work for you, for your family, for your business, and going to help you achieve the financial success that you've always wanted and quite frankly that you deserve. So for more, check us out online. We're at vfwealth.com. Would love the opportunity to work with you. If you have any questions, please let us know. Otherwise, certainly wish you the best of luck and look forward to having the opportunity to connect with you again soon. Take care. Thanks very much. As you know, we have a great compliance team behind us here at Veritas Financial, and they want to make sure a few items are clarified. So I'm going to put on my compliance hat and share their thoughts with you. First off, the purpose of life insurance is for death benefit. Living benefits are secondary. Regarding borrowing or withdrawing cash value, doing so will reduce the policy's cash value and death benefit, increase the chance the policy will lapse, and may result in a tax liability if the policy terminates before the death of the insured. For tax-free borrowing or withdrawing, this is true for amounts up to the total premiums paid into the policy. Life insurance is not a short-term accumulation vehicle, as it may take many years to develop sufficient cash value relative to the premiums paid. Any discussion of taxes is for general information purposes only, does not purport to be complete or cover every single situation, and should not be construed as legal, tax, or accounting advice. Clients should confer with their qualified legal, tax, and accounting advisors as appropriate. Again, thank you for watching this, and we hope you found this informative and compliant. Please reach out with any questions or to discuss your personal situation by calling us at 703-424-2401 or find us at www.vfwealth.com. Thanks very much. Have a great day.